of CFA Society Spain. Um, so to let me start with the mentioning a couple of things. So one is that this event will be recorded, like many online CFA Society Spain events. And the other thing is that there has been an issue in the invitation with the names. So please make sure that if you don't see your name properly, if you see yourself registered in a different name, please try to update your name. Just because there has been a confusion and there is a name that has been maybe repeated many times. So just to let you know that. And so then we can start. So we have here Matthew Savary and Christoph Jacks from BCA Research. I have been using BCA Research in my work quite a lot. It's in my opinion the top research investment research house. I have been using it into different companies, and I think that the quality of the research is top. And Matthew is the Chief European Strategist of BCA Research, and he will be talking about the outlook for the global economy and the European economy, and then at the end, a tiny bit about Spain. And also he will focus a lot on the economic implications of in different asset classes. So without further ado, Matthew, do you want to go ahead?
Yes, thank you very much, Alex. So first of all, it's a pleasure to be talking with you today. I mean, this evening more specifically. When it comes to the way we're going to do this presentation, obviously I'm going to do my presentation, but I'll make sure to keep some time at the end to answer questions. So you just need to raise your hand, and then you can ask the question as I call on you. Just a few words very rapidly on BCA Research before we go into the meat of the presentation. So Alex has had some very kind word for our firm. We are a consultancy that specializes in analyzing markets from a macroeconomic perspective. So we put a lot of emphasis on global economic trend, inflation trend, monetary policy, to make call on asset markets. So we have a very much top-down approach to markets. We cover all asset classes around the world. Here, the presentation today will have a focus more on Europe, but we really have a broad-based focus. Beyond providing research in written content, communication like the such with clients in terms of webcasts and things like that, we also offer other services such as our BCA Academy, which are seminar offered regularly online or even in person again, where we help investors incorporate macro analysis into their processes to help them do so in a more rigorous way. So we regularly offer those courses, and we're going to have some of those courses offered in Europe over the course of the next few months. So without further ado, let me share my screen to share my presentation. Okay. Okay, so Alex, can you see the screen?
Yes.
Okay, good. So I can begin.
Screen.
Thank you very much. So in terms of the presentation that I'll do today, obviously, as I've mentioned, we'll talk about the global economy, and we see still some headwinds in the near term to the global economy. But what's very interesting, especially when we look at Europe today, is that Europe is benefiting from a unique set of tailwinds that will allow European growth to continue to surprise to the upside, as it has done in recent months, to maybe even beat US growth this year. And we believe this is an environment that will be actually quite positive for European equities. In fact, something we can address more in the questions, we are increasingly positive on the structural view, on the structural investment horizon on Europe relative to the US, and arithmetically due to the weight of the US in global benchmark. That means we have an overweight on Europe on a structural basis in global benchmarks. We've seen other dimension. We're also positive on the euro. We've been positive on the euro for a while now. And while we see some near-term risks, ultimately we do think that the euro bull market has only begun, and the euro is likely to end the year toward between 115 and 120 on a euro USD basis. One last word before we go to the actual presentation. Our favorite way to bet on Europe right now is actually small cap stocks, which we like in absolute term, but we also like them relative to European large cap equities, as well as relative to US small cap equities. And just as an aside, our US equity strategist is also overweight US small caps. So this means that European small cap stocks really stand toward the top of the pyramids of global equities at this point in time. So let's look a little bit at the factor that underpins those views. So let's look a bit at the global economy, what's hailing it. So in terms of issues as drags that we see in the near term, they're the following. First of all, we do know that global monetary policy continues to be tightened. We see the Fed that continues to increase interest rates. And this is still having an impact on the global economy, particularly in the United States. On the left side of the page, you can see that while goods spending by household was very strong during the pandemic, it's been slowing down, in part because it moved way above trend. So there's a limit to how many goods people can accumulate, how many goods they need. But additionally, the tightening in monetary condition that is taking place in the US economy is contributing to a further deceleration toward trend in terms of the consumptions of goods in the United States. And that's a little bit of a headwind for Europe due to the fact that it has weak goods consumption in the US, a negative impact on US import, which means a negative impact on European exports to the United States. And in the near term, we see some risk that this negative profile for consumption in the United States, especially for goods consumption, could last a bit longer. You can see at the bottom left corner of the page that mortgage rates, the green line shown inverted here, have really increased a lot, which has translated in weakening pending home sale, and house prices in the United States are under duress right now, which is contributing to souring a bit the mood of households and their propensity to consume, especially on durable goods. Now there's the question of China. There's a lot of optimism related to the fact that the Chinese economy is reopening. And this is definitely a positive for the global economy, because at the very least, China, which was and has been a drag on growth for the last 2 years or so, for the last year or so, is not a drag on growth anymore. However, there is a bit of a factor we need to take into account, which is simply the fact that the main beneficiary of the reopening of the Chinese economy is actually the domestic economy itself, the consumer sector, and particularly the service sector in China, which has withstood the worst impact of the zero COVID policy. And when it comes to the goods sector, especially the industrial goods sector that are so important to global growth, the picture is a little bit less bright. What you can see on the right side of the page, it's a chart from our emerging market strategist, is that the weakness in the government bond issuance at the local level is historically a forecaster of infrastructure spending. And this means that, yes, the Chinese economy is opening. Yes, the authorities are loosening rules in the real estate sector. But countering this positive, we are also seeing that infrastructure spending is likely to slow in the first half of 2023 in China, which will limit the positive impact of China on the global economy. So now let's move a bit to Europe itself. Because as I mentioned in my intro, Europe is benefiting from idiosyncratic factors. That means that even though Europe is highly geared to the US and the Chinese industrial cycle, Europe is likely to perform better than those two variables are suggesting it would right now. So one of the key factor here is our expectation that the worst of the European energy crisis is behind us. In fact, we do expect average natural gas prices in Europe in 2023 to be significantly below the level that prevailed in 2022, creating a big tailwind for the European economy. So why is that? Well, to a large degree, it's related to price signal. We know that natural gas prices in Europe have corrected massively. They were at roughly 300 euros per megawatt hour this summer, and today they are trading between 60 and 50 euros per megawatt hour. Yet, what you can see that's very interesting is that the volume of LNG being delivered in European regasification facilities continue to increase, and in December hit a record high at a level even higher than what we witnessed when prices were at roughly 300 euros per megawatt hour in the Netherlands. So we are seeing that natural gas continues to make its way to Europe. Additionally, Europe continues to add capacity to absorb global natural gas. What you can see on the right side of the page is that today there's roughly 200 billion cubic meters of capacity of reliquefaction of LNG in Europe. By the end of the first quarter, it will be roughly 240 billion cubic meters. By the end of 2023, we will hit roughly 260 billion cubic meters. And by the end of 2024, the Bruegel Institute expects that this capacity will have risen to almost 280 billion cubic meters. So that will continue to facilitate the transition away from Russian natural gas. And what's very important here is that Europe is building a lot of capacity, but at the current level of imports of LNG, which are at a record high for Europe, it still only represents 21% of the LNG exporting capacity of the main LNG exports. And what we're seeing is that over time, the US continues to add to its capacity to export LNG. So does Australia. And Qatar is opening its North Field in 2025, and we already know that Germany has bought in forwards the bulk of that output. So this suggests again that the pressures on the European natural gas markets are ebbing. Now, this view is not without risk. The most evident of those risks is the reopening of China itself. You can see on the left side of page 4 that as the apparent consumption of natural gas in China flatlined due to the zero COVID policy, the daily import on a net basis of LNG declined substantially over that time, which logically suggests that as China reopens, the apparent consumption of natural gas will pick up, and so will the LNG imports of that country, which means that a mighty competitor to European purchases are likely to emerge over the course of 2023. Well, this is a big risk. This risk has an important offset, which is also in Asia, and that is Japan. Japan, on a net basis, imports today as much LNG as China did at its peak in 2021. However, the Japanese are tired of paying European natural gas prices because Europe is setting the price for natural gas. And this is causing a reaction, which is that Japan is looking to reopen its nuclear capacity over the course of 2023 and 2024. So this is very important because you can see that the import of LNG in Japan increased tremendously in the wake of the nuclear power plants closures after the Fukushima catastrophe. And as soon as a little bit of capacity in the nuclear power reopened, we saw some decline in LNG imports. And we expect that as further reopening takes place, greater decline in Japanese LNG imports will take place, offsetting in part the increased demand from China. So practically, what does it mean? It means we expect average LNG natural gas prices in Europe to be around 100 to 120 euros per megawatt hour over the course of 2023, which is below the average and substantially below the average of 2022. So this is very positive for Europe because it will also mean lower electricity prices. And anyway, we've already seen electricity prices normalize to a large extent in the French, Spanish, or German markets. So why does this matter? It matters a lot for a few reasons. One of them is inflation. Inflation, which is obviously related to the energy problem, was the great problem, the great shock to Europe. It hurt everyone in the economy. It did hurt businesses, it did hurt households because it weighed on real income. So if we can see a decline in inflation, that will have great dividend for the European economy. And we strongly expect this decline in inflation to take place. On the left side of the page, you can see that the headline CPI has been tightly co-integrated to energy CPI, and the weakness in the energy CPI is likely to result in further slowdown in headline CPI. And what's very interesting is the chart on the right, which highlights that there's been a great degree of pass-through from energy CPI to core CPI, in part because the cost of electricity, transport, etc., have increased in response to those higher energy prices. And what we anticipate is that over the course of the next few months, we'll start to see a rollover in core CPI, in big part because as it took a few months for core CPI to reflect the increase in energy prices, it will take a few months for core CPI to reflect the decline in energy prices in Europe. We also see that the labor market is not as worrisome as many fear in Europe. The chart on the left comes from an ECB survey, which highlights that, yes, we've seen stronger compensation growth in recent months in Europe, but this was mostly an aftershock of the programs put in place during the pandemic to protect jobs, which resulted in a very below trend pace of wage growth in Europe while all those short hours programs were put in place. And as the economy normalized in the second half of 2021 and 2022, this yielded a period of above normal compensation growth in Europe. But even with this, when we look at negotiated wages in Europe, they are growing at roughly 2.9%, which is relatively elevated for the history of the past 10 years in Europe, which was, after all, a very disinflationary, deflationary even environment. But it's still very far from the level in the US, where we saw, for example, the Atlanta wage tracker growing at 6.5%. And the chart on the right helps explain why we are unlikely to see European wages reaching the kind of growth that we observed in the United States. And it's simply that there is a lot more slack in Europe relative to the United States. You can see here a measure of job market slack represented by the ratio of job vacancy to the unemployed, to the number of unemployed. And you can see today that this ratio, when you look at US minus Europe, is at a record gap. So the labor market in the United States is the tightest it's ever been relative to that in Europe. So this suggests that the fear of having the kind of wage dynamic that we observe in the United States develop in Europe is actually exaggerated, and that when we look at the results from wage negotiation that took place in the winter in Germany, we are not seeing big signs of worry yet, which is something the ECB accepts too. So why is this inflation mattering? First of all, to a large degree, lower inflation will boost real income, which is going to be very positive for consumption. But also you can see that inflation expectation, the dotted line in those charts, is a great explanatory variable for savings intentions. And historically, we observed that inflation expectation track realized inflation. Hence, a decline in realized inflation is likely to yield a decline in inflation expectation, which will help bring down the savings rate in Europe and help also the accumulated savings, which are above 1 trillion in terms of excess savings in Europe, according to Isabel Schnabel from the ECB. So it will help those excess savings make their way in the economy. And this will be very positive because we're already seeing signs that consumer confidence, the solid line here in Europe, is rising, and the improvement in the ZEW growth expectation survey is consistent with further improvement in consumer confidence over the rest of the winter and the spring months in Europe. So why does this matter? It's because we see a lot of pent-up demand in Europe. So we've shown at BCA very often that the aggregate consumption of durable goods in Europe in real term is still today at the same level as it was in 2019. So they flatlined for almost 4 years now, which is inconsistent with income that have risen over the time frame, and therefore suggests that there is pent-up demand, especially if you compare to the United States, where we saw consumption of durable goods move massively above trend. So there's a lot of pent-up demand in Europe. And nowhere is this more evident than when you look at the car sector. You can see on the top left corner of page 9 that new car registration in Europe have rebounded from the worst day of the pandemic, but they are still below the level that prevailed in 2012, 2013, when we were at the worst of the European sovereign debt crisis, which was a very dire time for Europe. So this low level of auto sales suggests that we have a lot of pent-up demand in durable good, and especially in this primordial category, considering how much gross value added in Europe comes from the automobile sector. So if we are right that inflation declines, that real income of the households improve, that savings rate decrease a bit further, and that the excess saving built up during the pandemic are being unleashed in the economy, we would expect that all durable goods, but cars in particular, will experience a pretty significant tailwind over the course of the next 12 to 24 months. So the benefits of lower inflation and lower energy prices will not only accrue to the household sector, they will also benefit the corporate sector. On the left side of the chart of the page 10, you can see a bit why. The European current account balance on a 12 months rolling basis has really collapsed. And you can see now that it is below, it is negative essentially. But what's very interesting about this chart is that if we exclude the energy sector, you can see that, in fact, the European trade balance has done nothing. It's been very stable and hasn't declined at all. So the entirety of the deterioration in the European current account and trade balance is actually a consequence of the energy crisis. Hence, as energy prices decline, we are likely to see that the trade balance will increase over time. And in fact, when we look at the month-on-month data, which is a lot more volatile and noisy, we're already seeing that the euro area trade balance is back in positive territory, and the German current account balance has moved back to the level that existed before the energy crisis. The other element is related to terms of trade. As you can see on the right side of page 10, real energy prices, the solid line, when they rise, it's associated with a deterioration on European terms of trade. And that was the biggest contributor to the massive worsening that we saw over the course of the last 2 years in European terms of trade. So terms of trade are the price of export relative to the price of imports. And as we expect real energy prices to decline over time, especially this year in relation to the levels that prevailed in 2022, we would expect the terms of trades in Europe to increase, which historically is positive for profits, is positive for capex, and is positive for economic activity in general. In fact, what you can see on page 11 is that the evolution of the ZEW growth expectation survey is already consistent with further improvement in the German IFO business confidence, and is also consistent with the manufacturing PMI for Germany, but for the euro area as a whole, experiencing more upside over the course of the next few quarters. So practically, this means that those domestic factors, which are strong and potent in Europe, are already creating a very important offset for any problems taking place in the global economy. And I would go one step further, that when we look at the global PMI, the new order to inventory ratio is already improving, which historically is the single best leading indicator of overall global PMI. So not only are we seeing domestic factor in Europe that point toward an improvement in European manufacturing activity and overall economic activity, but in fact, the global economic variables are telling a similar story. So what does it mean for policy and for European asset prices? So let's begin with policy. We believe that the ECB is not far off the end of its tightening campaign. Today, the deposit rate is at 2.5%, and it is expected based on the ESTR curve to move between 3.25% and 3.5% this summer. And we think this is roughly right. The ECB has hinted last week that there will be another 50 bips hike in March, and that after that they would reevaluate, but already acknowledging that inflation is surprising to the downside. Secondly, we are, by all metrics, seeing that rates today in Europe are above the neutral rate. So the neutral rate is the rate of interest rates that is neither stimulative nor constraining of economic activity. It's difficult to evaluate, especially in Europe, because there are many neutral rates. And what we do is that we evaluate the real neutral rate for each country, and then we calculate an average for the Eurozone. So when we take the textbook definition of R star, in real term, it's roughly minus 0.3% for the euro area. And the adjusted R star, which takes into account the indebtedness of the various economies, is at roughly minus 1.4%. So our expectation is that headline and core CPI will decline towards 3% in the first half of 2024. So this means that our estimates for the nominal neutral rate in Europe is roughly between 1.5 and 2.5%. And we are above those levels. And we are seeing the signs that we're above those levels already. For example, the number of unemployed in Spain is starting to rise. House prices in Germany and Italy are contracting. And most importantly, monetary growth, M1, has collapsed to 0.6%. Credit growth for households and for corporation is slowing very, very rapidly. We're seeing lending standards that are being rapidly tightened across the Eurozone for both households and corporation. And various measures of credit demand are decelerating sharply, with in particular demand for mortgages falling to the lowest level since the ECB started to collect lending intention from banks. So all those are clear signals that the ECB policy rate has moved into constraining territory and that the ECB is close to ending its tightening campaign. So now let's move on to market calls before we open to question. The first one is the question of the euro. We believe the euro still has significant upside. On a 2023 basis, we expect that the euro could end the year somewhere between 115 and 120. But on a longer term basis, so 2025 or so, we believe the euro could move toward 140, 150. Why is that? Well, first of all, the euro is still very cheap, which is what both the chart on page 13 highlight. You can see that relative to purchasing power parity, so here it's shown inverted, the euro is trading versus the US dollar at a roughly 30% discount, which historically is associated with subsequent 10-year annualized rates of returns of roughly 5% per annum. So this is already a pretty strong signal for the long term. In terms of interest rate differential, you can see right now that the euro still trade below the level implied by the one-year forward spreads in German and US rates. I use German rates here because they're the closest thing to a risk-free rate we have in the Eurozone. But still, we're seeing that the euro is still very cheap even considering interest rate differential at the current juncture. But to me, the most important dynamics when it comes to the euro are the one on page 14. So the green line here is a proxy for pricing power of the corporate sector. It shows the consumer prices divided by the producer prices. So it's essentially a measure of the ability of businesses to pass on their rising input costs to their customers. And the way this dotted line here is shown is that we take the pricing power of Europe, so the ratio of CPI to PPI in Europe, and we divide it by the pricing power metric for the United States. And here we saw this collapse that took place in 2022. So now we can really easily make an attribution analysis in terms of what drove the collapse in the European pricing power relative to the US pricing power. And it's really down to one variable, the European PPI that surged in response to the surge in European natural gas prices. And now that we're seeing energy prices, not just natural gas, but electricity prices ease in Europe in absolute terms and relative to the rest of the world, we're starting to see embryonic signs that pricing power in Europe is improving in absolute term, but relative to that of the United States as well. And this is very important because the euro was the relief valve to help the corporate sector remain profitable despite the lack of pricing power. So as we see the pricing power recover in Europe, there is less of a need for a very cheap euro to alleviate the pain caused by the energy crisis in Europe. And this is likely to be very, very positive for the euro. The last reason why we anticipate that the euro has further upside is related to what has driven the very sharp rebound in the euro that has taken place since October 2022. So you can see that speculators have moved from being sellers of the euro to being on a net basis buyers of the euro. But what's very interesting is that they haven't really accumulated additional long bet on the euro. What they've mostly done is to curtail their short positions in the euro. So the rally that we've seen until now in the euro wasn't really a rally driven by euphoria and great optimism about Europe. It was a short covering rally. So that's why we think that there is further room to see euro buying take place over the course of 2023. Now, the near term is a bit tricky because the reality is that the euro has moved massively over the course of the last 13 weeks. And you can see here the annualized 13-week rate of change of the euro has hit almost 50% at some point. Because it was going at 13% or so. And the euro has become very overbought. Moreover, when you look at risk reversal, so the implied volatility of puts relative of calls, relative to the implied volatility of puts, you see a big adjustment in terms of the pricing too. That's consistent with a lot of the short covering being over right now in Europe. So this suggests that over the course of the next few weeks, so a few weeks to put a window around that, I would say the next 13 weeks or so, so 3 months, we are likely to see the euro move either sideways or even experience a little bit of downside toward 105, 104. Now let's move on to European equities. We like European equities. We like them in absolute terms and in relative terms. In big part, you can see that European equities are a lot cheaper than US equities. US equities have experienced a significant haircut, but they still trade at a PE ratio, Schiller PE, that is greater than what was the case in 2008. In Europe, this is not the case. The Schiller PE is at an enormous discount to the US valuation, but it's also trading below the level that prevailed in 2008. And what's very interesting are the dynamics in terms of stagflation fear. So the green line in this chart is our stagflation sentiment proxy. So what is that? This is the ZEW survey growth expectation minus inflation expectation. So when the green line is rising, it is telling you that investors expect a low inflation boom to take place. And when the green line is falling, it is telling you that investors expect stagflation to be the dominant economic environment over the next few months. And what you can see is that, as was the case in 2022, we saw this rapid contraction in the stagflation sentiment proxy, which tell you that investors got very worried that Europe was going to be mired in deep stagflation. And as a result, European share got derated. So that contributed to this big shock to the European PEs. And now what we're starting to say is that investors, because energy prices and inflation are turning the corner and growth is surprising to the upside, are moving in the opposite direction, and they are not fearing stagflation anymore. And that should allow for a re-rating in Europe that is unlikely to take place in the United States. So that's the first very positive factor for European equities relative to US equities. The second factor that, in our opinion, is likely to contribute to a re-rating of European equities is that Europe is passing test after test successfully. Last decade was a catastrophe for Europe. There was fear that Europe would break up. Europe was embroiled in austerity that accentuated deflationary forces, and so on. This time around, we saw that Europe conducted fiscal policy in a smarter fashion than the United States and Anglo-Saxon economies during the pandemic. Europe is surprising to the upside in terms of its ability to abandon Russian energy. And you can even see from the chart on page 18 that Europe was able to move away from Russian energy, which to many observers was going to call the death knell of the European industrial sector, without a hit to profit. And in fact, what we observed is that the German industrial sector, which was the most dependent on Russian natural gas, was able to curtail its consumption of natural gas by 20% without cutting production. So efficiencies got found. And that to us is another very well-passed test for Europe that has supported profitability and supported the perception of strengths in Europe amongst investors. And when we add to the fact that the breakup risk premium in Europe should be around zero now, people are not leaving the euro but are being added to the euro. Think about Croatia at the beginning of the year. Think about talks about the UK now that looks to come back to the European Union. 60% of Britain respondents are in favor of joining back the European Union today. This suggests that the viability of the European Union and of the euro are not questioned anymore. And if we add to that the existence of the NGEU program, which reinforces which created the first embryo of common fiscal policy in Europe, this augurs well for the survival of Europe. So last few points I want to highlight. The same near-term problem that plagues the euro, namely the fact that it is overbought on a near-term basis, exists also for European stocks. You can see that European equities have become very overbought on an absolute level, but you can see also that in relative terms, relative to the United States, they are even more overbought. So we think that it is also the case that a period of digestion for European stock is likely to take place. In fact, it's likely to take place for all the stocks around the world. But Europe is likely to underperform a little bit in the US in the very near term during that time frame. Because it's more overbought. But to us, this is just a buying opportunity, and that's it. So two final points. First of all, as I mentioned in my introduction, the best way for us to play Europe right now is actually the small cap space, not the large cap space. Why? Small cap stocks derive a greater exposure to domestic economic activity than large cap stocks. And what we think is the special ingredient that make Europe shine right now is in fact the domestic economy, the benefit to consumption from lower energy prices and from lower inflation. And that mostly benefit the small cap stocks. Secondly, small cap stocks outperform large cap stocks when the euro appreciates. Why? Because the strength in the euro correlates usually with an outperformance of domestic economic activity relative to the United States. And secondly, the rise in the euro affects more the translation of benefits of profits that represent a greater share of profits for large cap stock than is the case for small cap stocks. So this is likely to be in a context where small cap stocks are oversold relative to large cap stocks and are cheap relative to large cap stocks, an environment where small cap stocks in Europe will perform very well. Which is essentially what the charts on page 20 are highlighting. So a few words on Spain. I'm, after all, addressing the Spanish CFA Society. So the Spanish market is a bit tricky right now, because as you can see from the chart on the left side of page 21, the biggest driver of the underperformance of Spain over the course of the last 12 years has been more to do with the composition effect of the market, which overweighted utilities and financials in particular than with a Spanish effect per se. We can extract that from looking at the equal sector weight of Spain versus Europe compared to the normal expression of the benchmark. Now, during the pandemic, we did see a bit of an underperformance of Spain in an equal weight, and that could dissipate to some degree in the next few months as the Spanish economy has been catching up to Europe in part because of the re-arrival of tourists in Europe. But sectors continue to constitute a bit of the big problem for Spain in the near term. So there are two issues here. In the near term, we're worried about financials, which are a huge weight in Spain. Why is that? Well, it's related to the fact that the ECB has brought rates above the neutral rate. And we are seeing credit activity slow down across Europe, including in Spain. And Spain has a large prevalence of new mortgages that have been issued at variable rates, which means that it's going to be difficult to sustain the creation of mortgages with rates that have risen. So that means that the fees of banks are likely to rise, to do not rise as fast as they had risen over the course of the last few months. And that could weigh on the performance of financials. Now, the way we like to play this is that actually we see the Spanish fundamentals as being stronger than the rest of the euro area fundamentals. In particular, Spanish banks sport stronger ROE than other euro area financials. So we like to be long Spanish financials relative to European financial ex Spain. The other problems for Spain is the utility sector. You can see on the right side of the page that Spanish utilities have strongly outperformed the broad market and have strongly outperformed the euro area as well. The bad news, too, is that they've not outperformed, especially in the last 12 months, due to profit outperforming. It's been purely a multiple expansion. And we are worried that over the course of the next few months, as the economy recovers globally and as Europe does pretty well, better than expected compared to what was feared originally, defensives will underperform, and Spanish utilities, which have been some of the strongest defensive sector in Europe, are likely to bear the brunt of that pain. So to resume, in Spain, we like financials relative to the rest of Europe, but we are negative on utilities relative to Spain and relative to other European utilities. So I'll end here to make sure to be able to address questions.
Okay, so I'll go. Thanks a lot, Matthew, for the insightful presentation. So I'll go with the first question. You said that in the initial slides, the chart about the increasing capacity of LNG, which, if I did the math correctly, should be around a 30% increase, right? From below 210 to above 270. So yeah, with 280. So in terms of what's needed to get out of the danger zone, take into account that a part of gas comes through pipelines, not anymore from Russia, but through Algeria and so on. How significant is that in terms of the required increase to have a sufficient storage to be ahead of potential cuts in supply and competition from China in terms of demand if it arises?
So you're absolutely correct. Europe will not just be able to survive on LNG. Norwegian flows, which have played a very, very important role last year, will remain paramount to keeping the light on in Europe. And so are flows from Africa that comes via the Mediterranean. So I would say that one thing that worries us is, and we track very, very closely, is political instability in Algeria and in North Africa in general. That to us would be the main risk factor to cause another surge in natural gas prices if it were to take place over the course of the next 12 to 24 months. But we cannot forget also that Europe is doing a lot to decrease its consumption of natural gas. So as I mentioned in the presentation, we've seen big efforts to increase efficiency of production in Europe. As I mentioned, the German industrial sector has cut its consumption of nat gas by roughly 20% without much of an impact on production in terms of production of industrial goods. So this has been due to the shift from nat gas to switch to using oil distillates. So that's going to remain in place. Secondly, we cannot underestimate the role of households here. Households consume just as much natural gas in the EU as the industrial sector. So it's roughly 41% for each. Actually, it's 42% for household and 41% for the industrial sector. And the households are also cutting their consumption of natural gas. They're doing so in many ways. Some of it is by being more careful, turning off the lights in their rooms they're not using, wearing an extra sweater in their home in winter. But also here, there's a very fortuitous element, it's pure luck, which is that when you look at the NGEU program, so 750, 800 billion euros of programs, it's very skewed toward the green transition. And one of the biggest line item in the NGEU disbursement is actually renovations of building to make them more energy efficient. And while we have a firm view, some research we've produced at the end of last year highlight that real estate transaction, because of the increase in mortgage rates, are going to slow quite a bit in Europe. Construction activity is going to slow. Renovation activity, due to the subsidies that remain very, very important, will continue to flow through 2023, 2024. That will help to bring down the consumption of natural gas from households on a durable basis as well. So yes, in 2024-3, the risk from Algeria in particular remains more pronounced, but as time comes by, progresses, we think this risk will decrease because of the arrival of the North Field from Qatar and because of energy savings effort across the continent.
Yes. So one of the participants sent me his question, so I will ask it myself. So regarding the impact of higher rates in the housing and mortgage market, do you expect a lot of distress in terms of inability to make mortgage repayments, and also in terms of significant house price falls? What's the impact you forecast if rates evolve as expected?
So here, we do not expect a significant, we do believe that NPLs are likely to increase a little bit. It's almost unavoidable considering how much variable rate mortgages were issued over the course of the last 36 months in Europe. Now, that being said, we do not expect a large increase that would threaten the solvency of the banking system. To a large degree, there's simply the fact that the banking system across Europe is much more robust than it used to be. The Tier 1 capital ratios are well above the Basel III requirement right now in Europe. But also there's simply the fact that European households are sitting on a lot of equity on their home prices. And right now, they don't have any incentive to sell their homes. So essentially what we're anticipating is a bit of a state of stasis in the housing market across Europe, where not much transaction are going to take place because this is nobody's incentive. The sellers don't have an incentive to sell and the buyer don't have an incentive to buy. And because we do not foresee a big increase in the unemployment rate in Europe in the next 12 months, we don't see any forced selling that would catalyze a very sharp contraction in home prices and catalyze a big increase in NPL. So that's not our base case. Now, some markets are more worrisome than others. The two that stand at the forefront of our mind here are Germany, where house prices have been particularly strong and have more downside. And the top of the list is Sweden, where we are seeing house prices falling quite fast already. The household sector has a lot more debt in Sweden, and that creates more risk for the Swedish banking system. Again, we would be talking of house prices declining by 15-20% in Sweden, and probably 10% euro area wide. Oh, and the last point, sorry, I've forgotten because it's an important one. It is true that mortgage payments are rising, and that's a problem for households. But on the other hand, food payment and energy payments are declining and will decline further. So that creates an offset to that increase in mortgage payments.
Thank you. Any more questions? Okay, so I got another question written to me. Okay, so it's about the potential impact of China in the 1 second, because I got the question in Spanish, so I need to translate it.
Take your time.
Okay, yeah. So what's the impact of the Chinese reopening and a potential increase in the trade war tensions between China and the US in in the global inflation? And then how do you expect the deglobalization to evolve? Do you expect the trend to increase? Do you expect the trend to continue at the recent pace, or to get, or to stabilize, but not increase in a significant way? So these two points: global impact of China, and in essence, impact of China
Yeah.
reopening, and impact of trade war in global inflation, and then decoupling.
Yeah. So let's begin with the reopening of China itself. So first of all, the reopening of China will mostly benefit the Chinese consumer sector, and our emerging market strategists work suggests that the main beneficiary will be the service sector in China. So actually, we're a bit worried that China, the reopening story was a key fuel to the very rapid rally in EM assets, European assets, the euro itself over the course of the last 3 months or so. And that's partly why we do worry that there is a bit of room for Europe and the euro to pull back in the near term, because the consumption, the service sector of China benefits China and doesn't have a very strong impact on the global economy, especially if this slide is right. And we see infrastructure spending in China slow down. Now, the reopening also has benefits, which is that when it comes to inflation, the constant cycle that we kept getting in China of factory closure, problems in logistic because of the viruses, that's not an issue anymore. So that, on the other hand, is a bit disinflationary and will help deal with the supply side element of inflation. Over time, in the next 2 years or 3 years, the reopening of China will become inflationary, because the Chinese economy will reaccelerate, while the main benefit this year is likely to come for the service sector. Over time, that will filter through various sectors of the economy, and we'll see demand for commodities strengthen again, and the commodity appreciation caused by this Chinese reopening will filter through global inflation. Now, on the second point, which is the trade war, the trade relationship between the US and China. The US will continue to try to isolate China, and Europe will be stuck in the middle at the end of the day. We saw with what happened with ASML in recent days, whereas ASML, the Dutch semiconductor equipment manufacturer, accepted to the pressure of the United States not to sell its machinery to China. So this is likely to continue to take place over time. It's not an imminent problem for Europe, though. Europe still has some time to continue to sell to China. And then it's easy to also overemphasize the role of China for Europe. Europe sells a lot to emerging markets in general. And things like luxury goods and things like that are not what the trade war is about. The trade war between China and the United States now has morphed. It's not the brute force of Donald Trump putting tariffs on everything. What the US doesn't want is to lose its military edge. So what the US doesn't want is to sell chips and materials that can be used in military equipment. At the end of the day, it's what it boils down to. So while ASML might not be able to sell its machinery to China, Louis Vuitton can still sell overpriced bag to China, and Mercedes and BMW can still sell car to China. So those things are going to be a bit differentiated, because it's not the tension between China and the United States has evolved a lot as well over time. Again, it's not just about trade now, it's about military might and technological advancement. So when it comes to a lot of what Europe exports to China, it's not really affected by the trade war. But the high-tech goods, yes, that's going to be a problem. On the question of deglobalization, PCA, our firm, doesn't exactly subscribe to the deglobalization thesis. But what we subscribe to is the hypoglobalization thesis. It might be a bit semantic, but there's a big difference, because deglobalization implies a decrease in global trade. We are not seeing a decrease in global trade. Hyperglobalization is just telling us that the share of global trade in global GDP is not going to increase as fast as it used to be. And that we absolutely see that on a go forward basis continuing, because again, those kinds of tension between the various big blocs around the world, the Western bloc on the one side, the Russian bloc, the Chinese bloc, etc., means that's going to be a bit more difficult to do business than it used to be the case before. So what is likely to be the consequence of that is that the supply side of the global economy will not increase as fast as it used to be, which is compounded by the fact that the global population is aging. So the supply of worker in the global economy is slowing down as well. So this means in practice that we are likely to see one of two things happen over the next next 5 years, who have both the same impact. On the one hand, either central banks will tolerate that, and the slowdown in the supply side of the global economy, met with the fact that governments are providing a lot of subsidies in Europe, in China, in the United States to accelerate the green transition, we'll either see inflation being a bit higher next decade than was the case before, so averaging 3-4% instead of 2% as we saw after 2000, or central banks fight this phenomenon. And what those phenomena mean, less savings, more government spending, is that the neutral rate is rising. So they increase interest rates as well. So in both cases, higher inflation or central banks fighting this higher inflation via higher interest rates, you end up with a higher interest rate either way. So one of our big structural views is that global interest rates have not finished increasing. They're likely to pause in 2023 and for a big chunk of 2024, but the long trend is toward higher interest rate. And that also contributes to our structurally negative view on the United States, because this will continue to create a problem for the tech stocks that are overweighted in US indices.
Okay, thanks. So, final question. It's about exchange rates, the euro US dollar exchange rate. So, if the question says if the European economy continues to do well as you expect, probably the LNG demand will also increase.
Yeah.
So, in that scenario, from where would you expect the supply of LNG to come from? Any particular country, or because it may be, if it may be a significant impact, where do you think it would come from?
So it's going to continue to come from the United States. The United States
Mhm,
natural gas production keeps on increasing, and it's very
mhm,
profitable, even at current prices, for US natural gas producers to sell their natural gas to
mhm,
the to Europe. We are seeing
mhm,
also Europe signing big deals in terms of buying hydrogen from Canada. So
mhm,
that's going to be an important factor starting in 2025, if I remember
mhm,
correctly, the purchases from Canada. The Qatar is going to be obviously a big role here. Qatar is going to double its exports over the course of the next 2-3 years with the opening of the North Field. So these are the main providers, suppliers of natural gas in Europe. But what I would say is that natural gas consumption in Europe is not going to be as strong as economic activity suggests, because again, subsidies continue to be put in place to actually bring down the consumption of natural gas per unit of GDP. So that's very important. Second element is a bit more idiosyncratic, which is that France last year really accentuated all the problem in Europe in terms of natural gas, because France historically is an exporter of electricity. Last year it became an importer of electricity because nuclear capacity collapsed. Yes, because the river level were low, but mostly because the French had mismanaged their nuclear capacity for many years and needed to close a lot of power plants to do upkeep. Pipes were cracking and it was very dangerous. And this is over. We are seeing the nuclear capacity in France really renormalize very rapidly right now. So this also means that actually 2022 was an abnormally strong year in terms of natural gas consumption.
Okay, great. So yeah, so we don't have any more questions, so I think we can conclude here. So thanks a lot, Matthew, for this clear and very insightful presentation. I like that it had a clear thesis of by Europe. So it's always great when there is a clear view in a presentation in an investment presentation. And in this case, it was very clear. So thanks a lot. And thanks everybody from thanks to all the participants and the people who submitted the questions.
Well,
And
thank you very much for having
so do you
me,
want to? Mhm.
and have a great evening.
Okay. Yeah. Have a great evening, everyone. Bye.
Bye.
Thank you.